Welcome, everyone. Good morning to you and me. It's time. It's time for Charts and Chats with Gordon Scott CMT, and that's why you're here. That's why I'm here. Hope you're going to enjoy this today. I've got a very interesting guest, and before we get to bringing Wes on, I'm going to tell you how the markets are going. Let me share my screen and get going. So hopefully that'll come through. You can see that right now. We're looking at Cisco. I'm going to come right back to the Cisco chart. I texted out about Cisco being the stock that I want to tell you about today. I think it's good morning, Paresh. Going to be a really interesting discussion. So first off, here's how the markets ended up last week. S&P on the top, Aussie yen in the middle, NASDAQ on the bottom. And you can see they all sort of made this kind of dip and rebound. Notice that the S&P 500 actually seemed to close on a high there. I mean, like an all-time high. I don't know if it was above those others, but it was pretty close if it wasn't. And Aussie yen did not close on an all-time high. NASDAQ nowhere close. So if this continues, if markets go up generally, guess where these are going, right? They're going to make new highs eventually. We'll see about whether or not they get there. Meanwhile, over the weekend, the crypto markets did this. This is a 30-minute chart. Those others were daily charts. This is a 30-minute chart, and we've got the three most important cryptos here. This is Cardano and Ethereum and Bitcoin. So, people have been talking about how hot the crypto market is and, how it went crazy and so forth. It did. But, it really hasn't been going, really burning it up anywhere recently. And so the big question is, going to start back up again anytime soon? We're going to get another move higher? And certainly traders want to see that. A lot of buying going on to start the week. So interesting to see whether or not this is a week that we kind of forge our way to new highs and so forth. I like this start by Ethereum and Bitcoin. Checking out all that volume coming in here this morning, and we haven't even seen the open of the U.S. markets yet. So I think that's a great start. But I got to tell you, if you are new to the crypto game, there's some Actions 12th guys that they're deeper into the markets than I am. But what little I know about it is keep an eye on all three of these, and if these two start to jump further, this one's likely to continue. It used to be about 3 years ago, Litecoin and Bitcoin traded, pretty much in lockstep. Litecoin's kind of fallen out of favor, and Litecoin was literally just a, smaller, leaner, more responsive, theoretically, Bitcoin. The technology was the same. The algorithm was generally supposed to be the same. But see, Bitcoin had a few problems that really slowed down its network for payments processing. And Litecoin was, in theory, a way to kind of help solve that. They've found better solutions since then. So Litecoin's, it's not totally left in the dust. It's still moving up, but nothing like where Bitcoin has gone. Meanwhile, as Bitcoin had this big rise, Ethereum rose just as much, maybe even a little bit more, depending on the time frame you're looking at. That's because the the technology under Ethereum is much stronger and much more extensive than Bitcoin. And Cardano is like Ethereum. Cardano has had even more consideration for its technological strengths. There's critics on both sides, but Cardano's only $1 or less, and so I think that people really feel like, oh, I missed the big run up over here in Bitcoin. I want to get in on a coin while it's low. So I think that's a pretty big attractor. Whatever the reason, that coin's got a lot of room to run. And if the other two jump, it may well jump more. So keep an eye on all three. But why do we care about crypto? The crypto and the stock markets aren't the same thing. It's true. But if people are willing to take money and put it into the crypto markets, if they have money and are putting it into any market, that's an important sign. And so we look at the crypto markets, especially over the weekend, because, hey, if the sentiment, the attitude is, let's drive these markets to new highs, then good chance that stock investors will be similarly disposed. And so we're looking here at a very good start to the markets, which is why it's probably no great surprise that the 5-minute chart of the Aussie yen over the weekend and the NASDAQ futures, which, as we've mentioned every week on this show, are tightly correlated. And you can see that for the weekend, the Aussie yen has made a new high. Well, at least it bumped up and is right back down. We'll see whether that's going to go up there and hold. But the NASDAQ futures have yet to make a high. They flirted with it, but they haven't. So I kind of feel like that's in the offing. That's what's next for the first few hours of the market, is to break that high at 12,975 and keep going higher from there. Now, you've heard me. D-Day is coming May 14th. And I talked at length about this 2 weeks ago, made a little bit more mention of it last week when we had Sonia on. I don't have a lot of time to code through it today because I really want to take some time to introduce you to Wes and talk about some of the things he's got going on. But I found a way to still talk about the 56-week pattern and get it out to you, or without having to take a lot of time. And that is, I'm going to send you a link to this article. Okay. And if you don't get the link because you're watching through a non-Zoom platform or something, then no worries. There it is right there. Traderinsight.news, Traders Insight, etc. Look really quick, make a screen capture something. So what happened is that I wrote this article back in September of last year, and it went up onto Investopedia, and then Investopedia farmed it out to Interactive Brokers. Yeah, I'm all over the place. And so Interactive Brokers has it up on this website, traderinsight.news. And so it's out there and it's recorded for posterity. Kind of cool. I'm going to, oh, great. Mai's going to post it onto the Facebook and YouTube links. So terrific. There is the link. And so what you can do is read through this article and get a deeper in-depth. Please excuse the typos. I don't take any responsibility for that, but here is something on that chart that I did last September, and it's something I had forgotten about. See, I showed that there were 3 sell-off periods coming based on the way the markets had been performing. That March in 21 was the first. May 21 is the big one, the big red one there, and then another one in July. Well, the March, that was because of this little bump that happened in January of 2020, right before COVID. I don't know if you remember it, but there was this period where stocks kind of ran up really fast, and then they kind of calmed down a second. Then they struggled to make a new high, then crash. So that last little period through January, February, late January, early February last year was enough mathematically to trigger the 56-week pattern indicator, or indication, I should say. And therefore, we were due for a sell-off in March. Guess what's been happening, right? We didn't have this big blowout sell-off, but the market's been really choppy through March. In fact, it's had some kind of scares for most people who are buy and hold types. Let's go back there and just look at March. See, from the beginning of the year, we're getting this sort of upward drift, and then early in March, end of February, and then in March there, this S&P we're looking at. See these kind of big candles, tiny little candles through here, big candles. That's the scare I'm talking about. That's the sort of, and then the NASDAQ really had, some selling going on. But as the 56-week chart predicted from back in the day, that was not expected to be a big one because it was just a tiny move up. This is what the big one is. This is what's driving the ticking time bomb countdown clock for May 14th, red letter day, red candle day, whatever. I don't know if it'll be that day, on or around somewhere, right? That's when the timer is up. And it's like that scene in Independence Day, all those counters rolling down, and what's his name, Jeff Goldblum, his character is like, time's up. Yeah, that's gonna happen in May. Serious selling. Now, okay, I don't know, maybe it's not gonna quite happen that way, but there's a good chance that it will, because you just look at that. We have this huge run up since the pandemic lows. Somebody is going to be taking profits, and a lot of somebodies are going to be tempted to take profits. So until then, between now and May, the better the market goes up, the better the downward move is going to be. That is to say, a profitably tradable move will occur. And I hope that as you keep coming to this Charts and Chats show every Monday, that as we get closer and closer, we will talk more and more about the bearish trades that could go on. We will talk ETFs, SQQQ, TZA. We will talk option trades, low cost stuff that will have the chance of going very large in value. And we'll talk about managing your risk. We'll talk about, what if I'm in a 401k, I only get one trade a month. I'll give you some ideas on that, because I actually have family members that are in that exact same situation, and they're just waiting. Tell me what to do, Gordon. Tell me what to do. And I'm going to tell them what to do when the time comes. But for right now, the answer is don't go short. Don't get crazy. Don't go throwing on the put options. Make small little trades, bullish trades, little trades that you can expect to just take some profits on. One of those I'd like to recommend is Cisco. So from Roy, when does this pattern occur in the past 56 weeks? Is it during the 2008 crisis? Yeah, so the 2008 crisis, a couple of weeks ago, we made a quick mention of that. The 2000, I mean, it happens all the time. It happens, anytime the market goes up 7% or more in a 20-day period, 56 weeks later, you get some selling. And if the selling is small, then that means a big bear market's going to, or big bull market is going to follow it. If the selling is big, then that means a bear market could follow. After the bear market of 2008 and 2009, the 2009 bottom, that 2009 from March 9th to April 12th, that move was so fast. It was, a big upward move in a single month. And I can't remember what it was. I think it was 15% in just to start. And what happened is that 56 weeks later, it was 65% over the whole year that followed that. So 56 weeks later, then you had people sitting on 65% gains in a single trailing 12-month period, and they were just flush with profits, and they had to take profits. Well, when everybody takes profits all at the same time, that's a selling frenzy. That was the flash crash in May of 2010. Okay, we're looking at a May 6th, from March 9th to May 6th, right? The COVID lows were March 14th or so, 13th, 14th. And so we're looking a little bit later, March 14th or May 14th. That's the days that we're counting down to. So, okay, Roy, hope that made the answered your question. If that wasn't your question, you'll have to rephrase and try again with me. So Cisco, I got a look at Cisco here, and I'm going to tell you why. Maybe we'll get Wes to chime in on this, but for now, let me just tell you that this break, this big move that Cisco made on Friday, and this is on the weekly chart, what it has looked like. That is not an insignificant move. This is Cisco over the past couple of years, and the fact that it's broken out like this is really quite big. And so we'll come back and talk to that. But for now, it's time for me to bring on my good friend Wes Walton. And Wes, are you there?
I am here. Hello.
Okay.
Can you hear me?
Okay. Is it just me? That mic or that audio sounds really quiet.
Oh,
Can
it does.
everybody else hear him? Okay. Very quiet as well. Any way you can
All right.
give us a
Yes, I
little more
can.
volume there, Wes?
Yeah. One moment.
Oh, that's happening. There we go.
Wait, it's louder now?
It is louder now. Yes.
Oh, weird. I actually didn't do anything, so
Oh, it is weird. Yeah,
that
we
works
got
out
better
just
and
fine.
good coming from the other. So, all right, we're good. Okay. I don't know if you got video today, Wes, or not. I
I
know.
do. I was just working on the microphone first.
Oh, the
I don't know
audio.
if you
Yeah, yeah.
can.
No worries.
There I am.
There we are. Thank you. Thank you. Everybody, this is Wes. Wes and I have collaborated on projects over the years, and Wes is an avid forex and algorithmic trader, but really algorithmic in any market that he can write an algorithm for. Wes has this really interesting talent I want to tell you about. If you were in a webinar with Wes and he said, "Hey, let's build a robot right now," and asked everybody in the webinar to just sort of throw out ideas of what a robot might be that could actually trade well. He could, within 1 hour, take all those ideas and refine them, quickly backtest and make the robot as good as it could be, and then actually code it up right in front of you. That's Wes's talent. I have not met anybody else that can, on the spot, just quickly create robotic trading methodologies that work like Wes does. So he is your algo trading savant. And what we've got here is one of the reasons I wanted to bring him on was to tell you about a couple of algorithms that he has done and let you know the principle buried in them is actually a fascinating technique for trading, and we're going to talk about that. So how you been these days, Wes?
Pretty good, actually. I don't know, just building systems. That's
Great.
it's nice
So
when your passion happens to be your work also. So
yeah.
it's been pretty good.
So tell us a little bit, tell everybody what you had told me in the past week about the um, algorithms that you've developed most recently. We talked about the pip stacker and also the give me an update on the growth systems. We didn't talk about that, but that algorithm is really good. So give us an idea of what do you got going on these days.
All right, so we were gonna talk about pip stacker primarily first, I think. And
Yes.
so I don't know if it's okay if I share my system, or sorry, let's share my screen, if that's okay.
Let's see if we can manage that. I've stopped my share. You go right ahead. See what we get.
All right, let's share screen number 2. So what I decided would be the easiest way to do this, since I don't have any live trades going at the moment. I was thinking the easiest way would be to show system backtesting. And the backtesting that we do is with what's called tick data. Tick data means that all price changes that come through for a particular instrument are recorded into a database, and then we download that database, and then we run a backtest based on that data. Whereas with normal, I don't know, broker data that you would download on MetaTrader 4 in particular, it's not very accurate. It's not accurate at all, actually. It's supposed to be 1 minute data, but it's even worse than that. So we use tick data to replicate how the market would have performed had it been running live at the time. And of course, we all know the past performance is not necessarily indicative of future results. However, knowing how a system performed historically can help us to determine how it may perform going forward. So I don't know, half of what I do is back testing, and then the other half is forward testing and putting it into trading accounts to see how it performs in live market conditions. And the fastest way to see how a system has performed historically is, well, it's back testing. So what I'm going to do is show a chart with a divergence setup on it, which would be here. I don't know if you wanted me to talk about what divergence is, or if you just wanted me to jump right into
Yeah, go
what
ahead,
the
jump right
system
in.
does.
We'll assume that people who are listening have heard about divergences. If you haven't, go to Investopedia and search on the bullish divergence or bearish divergence, and catch up real quick with us.
Yeah. Okay. So I won't cover what divergence is. However, the pip stacker system and what Gordon and I had talked about last week is the idea of adding positions as a position goes into profit, and dividing the original position as you're moving up. And what I mean by that is, let me grab a Fibonacci line and change this to something other than that. I'm going to bring this down. Okay. And actually, I think I want to reverse that. We're going to put this going the opposite direction. That way we can see. Come on. Okay, well, it's not going, but that's fine. All right. So what we're doing here is drawing a Fibonacci retracement line, and along the divergence line, the formation of divergence right there. And as we go further into profit, if after placing a trade, wherever it is we decide to place a trade, then we use these levels to divide this first trade in half, taking some of the profit off the table and putting it into, adding to our account balance basically, and then adding an additional trade. So in this particular case, this is in live market conditions. So this trade has not actually come to fruition yet. It hasn't completed. But in this case, I'm using the chandelier stops to actually enter the trade. So after divergence has happened, then I would get into a
as an
trade once
entry, not as an exit. Okay, cool.
Yeah, as an entry. So the way that I figure is divergence is counter trend. So if chandelier stops offer you a good way to get out of trend-based trades, as you can see, it is a pretty good stop loss or trailing stop or exit for trend-based trades, then it should be a relatively good entry mechanism for counter trend systems. So after we
Okay, hold
see
on. I got to
bullish
stop you right there. That's
Yeah.
that's that is so cool and so big. I gotta make sure everybody understands what you just said and why that is so cool and so big. All right, so first off, Wes made reference to this thing called the chandelier stop. A chandelier stop was something that I actually introduced to you, right? You hadn't heard of that
Yes.
before we talked. Yeah, okay. And a couple of years ago, Wes and I were working on a project, and I explained to him that one of my gurus years and years ago was a guy who was a commodity trading advisor, and he was probably the world's foremost expert on exit strategies and exit signals. And he came up with this thing called the chandelier stop. You can look it up, but it's basically the idea that you don't just move it up. You pay attention to volatility. Wherever the stop is, you kind of adjust according to volatility, and at least in terms of uh, how you add, or I mean how you manage the position, you're always going to want to tighten the stop, but the indicator itself might actually go the opposite direction. Sometimes it looks like your implementation isn't doing that. That's good. It's easier to follow, but it tightens up when there's better volatility. And um, the idea is also that it's kind of paying attention to noise versus signal. And noise is like a candle that's a small body and a big set of wicks, and signal is a candle that's open high, close low, or vice versa. Large body, small shadows. Anyway, so that is turns out to be one of the best mechanisms for doing a trailing stop. And it looks like your platform there, smarttrader.com. Wes, you actually work on Smart Trader itself, right? That's the product of the company you work for, and
Yeah.
so you have that built right into your platform. Very cool. But as Wes is pointing out, if you're looking for a counter trend trade or something that's going to switch, well, if you're using one of the best trailing stop mechanisms there is, then if it triggers, if it trips, wouldn't that be a good indicator, a good entry indicator? The philosophy behind that is fantastic, and so I really think that's a great idea. I've not actually worked with a system that uses the chandelier stop as an entry, but I love the idea, especially of a bullish divergence or any kind of divergence. In this case, you're looking at a bullish divergence, right? So you hit the divergence, and then when it crosses the stop, that's your entry. That's basically the system we're talking about here, right?
Right. Yeah.
Yeah, it's not infallible, but in terms of philosophy, I love it. So how does it work? I
Yeah.
mean, how does it play out, you think?
So, well, all right. With regular divergence, you actually have a lot of false signals that can pop up. So if you just straight up trade bullish and bearish divergence, like you see bullish divergence pop up and then you immediately place a trade, then you end up having a lot of small losses before you end up getting to the larger gains. Sometimes you can have so many small losses that it ends up overtaking your gains. So it's not always necessary, and not all systems require it. However, I prefer not to take every divergence trade, so I use things to filter it out, or I use divergence simply as a filter mechanism. So with this, after we have placed the trade, once it crosses above the chandelier stop, then our stop loss is placed down here below the lowest low of this bullish divergence setup. And it depends on where it is you would like to place your stop. I usually use the 1.618 Fibonacci level, but I mean, to each their own, I suppose. So now the stop loss is placed down here, and the first profit level for our trade is at the 0.618 level. And you can see that it's not very far because this is just a 1 hour chart, and this divergence setup took place over a relatively short span of time. But our first profit target level would be here at 0.618. Now at that level, and I'm going to draw a line going across, that way we can actually see what it looks like. Do a horizontal ray, put that right there. At that level, we would actually divide that first trade in half. So if we started with, and I'm hoping everyone in here is familiar with lot sizes and everything with Forex, but if we started with one mini lot, 0.1, then we would divide that in half. So divided by 2 equals 0.05. So we divided it in half, we would take half the profit off the table, and now we would be left with a trade size of 0.05 for that first trade. We would place an additional trade after we've closed out half of this first trade. We place another trade, and it would be the same size. So let me write this one. So we place an additional trade at 0.05. So basically what it is that we had closed out of the first trade, we would add that onto the first trade again. So we would have taken half of this profit off the table, and it would have been added to our account balance, which is awesome. And then put another trade in.
So now when you do that, I mean, yeah. I know that people are out there responding like I did the first time you told me about this. You're like, what? You just took the trade off and you put it right back on again? Why would you do that? Okay, so let's verify. You take half of the position off. I mean, everybody knows about that, but you're saying you turn right around and put it back on. Do you put it on at the same place? Do you put it on a little lower, a little higher? You wait a minute? I mean, is there any variation there at all?
No. In fact, in the code for the automated trading system, it all happens within the same function. Even it'll close out half of this previous position, and it will then place this trade. So the variation of prices,
the bid-ask spread, do you lose that?
Yes. Yeah, you would lose the bid-ask spread.
Okay, no problem. Just want to make sure everybody understands that is what we're talking about. Now, it sounds perverse in some ways, but we talked about this, and this methodology actually works.
Right.
And at a minimum, I think there's a psychological, but yeah. So Gary's asking, do you do that second trade at market, enter at market, and where do you put the stop loss for the second trade? So, okay.
That is an excellent question.
Let's hear the details.
Yeah. So once you've placed the second trade, then you move the stop loss up. So the stop loss will no longer be at the 1.618 level. You would actually move it to the 0 level.
Oh, all the way to break
which
even.
Means that, yeah, well, it wouldn't be break even because remember we placed our trade over here.
Oh, right. No, yeah.
Based on this, but
0
you would move
level
the stop
of
loss
the divergence. Gotcha.
Yeah, the 0 level of the divergence setup. So then we would continue to do the same pattern going upward. Now, if this were showing all of the lines, which I was really hoping it would go in the direction that I was trying for. Actually, maybe that will work. There we go. Okay, I just need to press reverse. All right. So eventually we would try to end up all the way up here at the 1.618 level, which means that it would be higher than where the divergence had started. The divergence setup had started all the way just right here. And our main primary profit target is all the way up here at 1.618. But we're going to be closing out half of the original position again once we get up to I guess is now the 0 line. So once we get up here to the 0 line where the divergence had started, then we close out half of the original trade again, which would take this down to, let's see if we go 0.05.
Half of the remaining original trade.
Yeah. Which takes it down to 3 micro lots.
Yeah.
So we still have our.
If you started with 10 micro lots, then you get up to a point and then you close 5 and immediately put them right back on. And then you close 3 of the original one and put 3 back on. Is that right?
Yeah. So
and then what about the other, the new 5 that you brought in? What do you do with them?
That one's still going.
Okay, so you don't touch it.
Yeah, you wouldn't touch that one.
Okay.
All right, so then we'd have an additional add-on trade. Oh, there it is. But this one would be at 0.02 because that's how many lots we just closed out. So we've taken a little bit more of the profit off the table and added another trade at 0.02. So now we have three trades.
I said you took off 3. You only took off 2, and then you put those 2 right back on, is what you're saying.
Yeah.
Okay.
So this is what's left over is 0.03. I should have been more specific about that.
From the original. Yeah, no worries. Okay, so but the whole time, really, you've got one mini lot on the whole time.
Yeah.
Combined. Yeah. It's just that you're doing this little dance of taking them out and putting them right back in, taking them out and putting them right back in.
Right. Yeah. And then once we've opened up this
to bank pips.
Yeah.
Okay.
Yeah, we're trying to getting more pips, but also attempting to take some of the profit off the table as we're moving the stop loss up. That way our account balance isn't being drawn down if we end up going down a little bit against us. And we have a little bit better expectation of how much profit we're actually making from the trade. That was the original intent behind taking some of the profit off the table, closing out half the trade. Once we open a new trade, each level that we open a new trade at, we actually move the stop loss up to the previous level. So once we've opened up this trade, the stop loss is moved to here instead. I'm going to make this red so we can actually see that. So the stop loss would be moved to here, which means that our first trade would now be stopped out in profit. If we came back down, then our first trade would actually still have profit. Our second trade would be break even, and our third trade would be the one that takes a loss. But our third trade's only 2 micro lots. So that loss would not be very substantial. But we've already taken some of that profit off the table, so it makes up for it a little bit. Once we reach up to this final level up here, we actually just take profit, close out all the trades. So we can add an additional trade in at the 1.270 if we want to, if we feel like the move is strong enough. I usually don't, just because I'd rather not, I don't know, tempt fate. But some traders do use the system in that way. And you end up making a bit of profit here at the very end when you've got this trade that makes profit, this trade that makes profit, this trade that makes profit, and our original trade that makes profit. So you have all of those trades combining together to make profit. And if you're adding that last trade on, then that's just additional profit on top of everything else, because you don't, or at least I don't, divide any trades at this point.
It's such a fascinating idea. If people want to read more about it, there's that blog entry that they can check out, right?
Yeah. Actually, if you check out the blog entry, then there are some links to some webinars that we did where we actually built some trading systems. And one of the trading systems that we built, we based on this basic methodology. And you can see how we built it right there in the webinar. And it was free. The recording is free. So
that's blog.smarttrader.com, blog.smarttrader.com. Is that right?
Yep.
Okay. I'm just going to shoot that out to folks to let them know that that's where they can get more information, because we're clearly not going to be able to get into the details too much of that. But as you described it to me, that actually works. I mean, this put on, take off kind of thing. Now, I'm certain there are traders out there who's like, that is not my style. That's too spastic for me. I'm going to put it on and I'm just going to hold it. Yeah, great. This system would probably work well. But there's a psychological benefit to getting in, taking a little profit, moving up. And you know, if you're the kind of person that is an active trader and you're constantly wanting to do things, or if you've got an algorithm that likes to be very active and you want that kind of an algorithm, then what you do is you get the benefit of this thing that just sort of stacks pips, you know, and ticks higher. So it turns out to be, well, you got some results you can show us?
Yeah. So I, in anticipation of that question, I went ahead and performed what's called an optimization test, and the only um, uh, variables that I optimized or that I used in this optimization test were dividing at the fib levels. So dividing that first trade in half at each fib level that goes up, and placing trades at those fib levels. So on the one hand, because these are two variables we're talking about, we have dividing that first trade, which is this piece of text there, and then we have the adding of trades. So if all you wanted to do was just divide the first trade and not add on trades, or if all you wanted to do was add on trades and not divide that first trade, that's what we've got here. Because you can see that we've got this one, the results down here at the bottom are for dividing at the fibs, so dividing that first trade, but we don't place any new trades at the fib. So this is if you just buy at that chandelier stop cross, and then each level you're dividing that first trade. This one is where we don't do any of that. We just place the trade and we leave it open until it gets to the profit target. We don't divide the trade. We don't add on trades, nothing. That's what it is. This one is where we are doing both. We're dividing at the fibs and we're placing additional trades. And then this final one here is where we're not dividing at the fibs, but we are adding on trades. You can see that obviously adding on trades and not dividing that
basically.
Trade.
Yeah,
exactly. And that's also moving the stop loss up. So each of these has a stop loss at first, and it moves the stop loss up at each of those levels. So all of these have a stop loss. Just want to make that.
So that last one, which makes the most profit, this pip stacking method we're talking about doesn't make as much profit as that. That's what you'd expect. That is people, who are saying, well, you're going to lose the spread. This is so inefficient. Right? Well, yeah, there's the difference of efficiency, but what it has is a lot less risk because you're putting it on, taking it off, moving the stop as you put on the, add on, and the drawdown numbers speak for themselves right there. That's fantastic.
Yeah. I thought this would be the best illustration to show what the results can be. And it doesn't make as much profit. However, if we were to run this same test across more currency pairs, then you would start to see that this drawdown becomes a bigger issue on some pairs, especially things that don't react well to divergence. The Australian dollar, US dollar, for instance, can have a pretty significant drawdown when you're not dividing at the fibs, and when you're just adding trades on. Then this drawdown becomes significant enough to make this profit drop down below where we actually do divide at the fibs. So it's all a matter of perspective. If you want to take on the additional risk, then there is additional reward that could technically be made. It's just a matter of mitigating the risk.
Okay. So that is just shocking to me. Again, even as I hear this, that these numbers come up this way. And you said something to me last time or over the past week when we were talking that this could also work on stocks. That in U.S. stocks you might have now. U.S. stocks aren't this continuous trading thing, but yet this same dynamic could be playing out in stocks. Would you say that's true?
Yes. Yeah, that is true. And I did the testing when this system was first built, and this was I don't even know, 3 or 4 years ago. I ran the same tests on tick data for U.S. stocks, and the results were just as fascinating. Some stocks were very profitable. Some stocks were so-so. Some stocks lost money. It was, but overall, the running it on the S&P 500 ended up making a pretty substantial amount and outperformed the market if you're running it on all S&P 500 stocks, which of course you wouldn't. One thing that has stood true, I suppose, with divergence-based automation is that no robot can really replace someone's experience unless you have zero experience. If you have zero experience, then robot can probably help there. But someone who has a lot of experience with trading and technical analysis can usually pick out better divergent setups than a robot can, because a robot has to be programmed by a person and try to take into account so many different.
Take every trade,
yeah, exactly. And so
yeah.
when it comes right down to it, using a robot is fantastic, but if you can do your own technical analysis and then place the robot when you've done that, then that usually has a better outcome, especially with stocks, I think.
Yeah, that's good. That's really interesting to know. I want to ask here before I go on and start talking about Cisco and maybe get your input from some of this discussion we've had, Wes. But I want to ask everybody who's listening right now whether or not they are interested in algorithmic trading. Do you do robot trading or algorithmic trading? And if not, are you interested in that? Because I can have Wes back and have him talk about his most recent algo project, which is just really a mind blower to me. Uh, at a future point, we could bring him back and so Paresh says he's interested. Anybody else, please let me know. I would be grateful to have you text in and let me know that this is a thing for you. If you've never traded that way and you think, well, I wouldn't even know where to start, but I am curious. I also want to know that whether you're trading with robots or not, on purpose. Yeah, Gary knows you. He's asking, Wes, are you the one who built the Handyman 1.0 and 2.0 indicators some years back? I'm into algo too.
Gary, yes, and I remember you.
Gary Lim.
So, yeah,
yes.
that is fantastic. Yeah, I am the one who built those.
Good to see you again.
Nice
He says, awesome. That's cool. Reunion here. So, yeah. Not trading, but would be interested in learning about the robots. Yeah. See, the thing is, whether you're trading robots on purpose or not, you are trading robots. When your order gets sent to any broker, and it doesn't matter what asset we're talking about, the broker themselves, the exchanges, most of that is automated and robotic. That's why Jay Woods, who the very first guest I had on the Charts and Chats show when we started a little over a month ago, that's why I had him on, was that he was they had consolidated the designated market makers. He'd been a designated market maker for decades, and he couldn't come on a show like this. So his job got eliminated, and he was in between. He's now heading up a proprietary trading desk for an outfit there in the New York area, and he's not able to talk anymore because you can't be talking publicly when what you do is behind the scenes work. Well, he used to have me come down to the floor, the New York Stock Exchange floor, and he would show me it was all automated, and just millions, billions of orders floating by, and the computers are all just handling them. And so at the base level, computers are trading everything all the time. About 75 to 90% in any given market of trades that are actually executed are automated and robotic. So the idea that we are just trading manually is that's just between us and the keyboard. It really makes sense to try to get some level of algo trading into your own mechanism. Now, at the time I have left, I want to talk about this Cisco trade and why I think Cisco is probably got the raw material for a very good trade somewhere in the coming week. And the kind of trade I'm talking about is buy a small dip and take profit somewhere within the next week or two. Now, of course, I could be wrong about May 14th and a big sell-off. It could be that you buy Cisco and you hold it for months and months, and it's a great deal. I think that that probability happens to be a little bit lower than 50%. But if that's the kind of trading you like to do, well, this is as good a place as any to start, and maybe even a little better than just the average. Why do I say that? Well, okay, so we're going to start up here in the corner. The Cisco weekly chart shows a massive breakout. Now think about that for a second. Cisco was heading downward when the rest of the market was going up, and then COVID hit. And when COVID rebounded, or when the pandemic, when the market rebounded from the pandemic, well, Cisco did too, but not as strongly. I mean, this is the first time that Cisco has hit a new high since from before the pandemic started. What is going on with that? This is Cisco, the people who sell routers and network components and the backbone of the internet, and they are the biggest work from home company that ever has been. They really are. I mean, I could go on with the people I know who actually work for Cisco, even at higher level positions. Those guys are the work from home pros. They have a culture of work from home. Yeah, right. They own WebEx now, right? So they, in fact, no, own WebEx. They started WebEx, didn't they? Yeah. Anyway, so you would think that like Zoom or any of these others, they would have been rip roaring, right? Well, no, because where Cisco makes most of its money is within a company. Like there's an office and you need routers all over the place. Yeah, they get the at-home routers that you buy from some retail outlet or Amazon or something. That's not where they make most of their money. Most of their money is there's a 100 or 1,000 employee company in an office, and all these little Cisco components and routers and software are all over the place for that company. Guess what? Nobody's renting retail office space. Well, little by little, right? Except now, finally, they're coming back, right? And that is the point. Here you have Cisco making this huge move over the past week, and travel companies and energy companies have been anticipating the rebuild, the reignition of the U.S. and world economy, and Cisco's been a little late to the party, but the travel and energy industries, they may be getting ahead of themselves. The investors in Cisco have been like, show us the money first. Show me the money. So they're going to do this now because they have a sense that, hey, there are companies. I mean, I got a call from a guy who himself was, he had the bad luck of renting out office space and paying 3 years in advance for the rent. And then comes the pandemic. Ouch, right? So he's finally saying, okay, great. We're going to be able to put everybody back in the office. He gets work from home and stuff, but he's already paid the rent. And there is stuff that he can do in the office production wise that's better. So he's got the keys to the office and he's reopening it and so forth. Well, that is just yet another indicator of there really are people moving back into the places where they use the stuff that Cisco makes its margin, makes its profit on. And investors and analysts are seeing that. And so now they're on board. Now, to me, I look at this and say, hey, that is a really good indication of the idea that the economy is going to jumpstart again. So if it's so, then here's what I find is a useful trading technique. Now, this is what I call my tall range strategy. If you have a single bar that is 1.4 or more times the average true range. So here's the average true range indicator on the daily chart. We're up at about $1.09. And Cisco right here, Friday moves from high to low. difference of 48 to 52, almost 49 to 52 and a half. So $2.50. So it's not just 1.4 times the average. It's, more like double or plus the average, two plus the average, right? So that is that qualifies. Now, what I find is that there's a 58% chance that you will get a pullback off of that bar within the next 5 days, but that within the next 20 trading days, about 1 month, the chance that you will end up higher than where this bar closed is substantial. It approaches 60%. So as far as an edge, it's a signal that has some really useful edge. And what you do then is you buy the dip. And so I've got a green box here. That's the target area. Now, there are times where the price just takes off and keeps going, right? So I tend to be the guy who just buys the open the very next day. But the very best trade, especially for Cisco, because Cisco doesn't, it's not this takeoff rip roaring stock. It's we're probably not going to see it go from 50 to 100, 50 to 70. You could do that in a fair, fairly quick period. 50 to 60 before May 14th, we could see that. But the best way would be grab that dip if you can get it, because Cisco fluctuates a lot. So I think anytime over the coming week that you can buy Cisco between 51 and 52, if you wanted to try this, and then you set your stop loss down there around 49.50 or lower, depending on how much room you want to give. And then you make your target price dependent on how much of a probability of win, right? So in other words, you want to have a 65% chance of winning or better. Take half of the profit that you set the stop loss for. So let's suppose I get in at 51 and a half. I set my stop loss at 49 and a half. That's a $2 stop loss. I'm going to take half to profit target, $1 higher. I'm going to actually take profit at 52.50. If I get $1, I got it done. I can always come back in and do this again. But there would be a 66.6% chance baseline that I would win that. When you add the tall range on top of it, that bumps to about 69-70% probability of winning that trade. So that is a really great trade setup. Now, if you're the kind of person like, no, I like to get a little more meat on these bones. So then what you want is a stop loss $2 lower and a profit target $4 higher. The chance that you'll actually get that profit target is by default about 33%. So you got to be willing to, be the strikeout king, right? You miss most of the time, but when you hit big. So that's it just depends entirely on how you want to make the trade. Roy asks, hi, Gordon, thanks for the suggestion on Cisco. Can you also recommend a good stock to short as well around May 14th, or do you not recommend shorting stocks? I absolutely recommend shorting them coming into this setup, the big red letter day. And the short is, I mean, the simple answer to your question is anything that's weak is a good short. So Apple has been terribly weak. I've never been bearish on Apple, but lately Apple's been really weak compared. So I'm keeping an eye on it because I am going to hit some put options on that baby when the time comes. The time is probably not now. So needs good Q3 results and positive guidance. In order to make a really big move. That's why I'm saying it's got a nice start. With this nice start, you're going to have a slight statistical edge that you can make a quick hit, move in, move out. Hi, Gordon, quick one. What kind of effects will the Suez Canal blockage have, if any, just in time latent effects? That's a great question. And I really don't know the answer. I kind of feel like we would have been seeing a rise in oil prices, should have been seeing a rise in oil prices if the Suez Canal was going to have any effect at all. And just, because we're going to constrain supply. but would it impact the supply chain for technology? Oh, I see. Okay, components coming through Suez. Gotcha. Good question, Greg. Uh, that is a really good question. I'm going to have to study up on that because I don't know the answer to it. I had not been expecting that the canal blockage would impact tech, but I mean, if you're going to constrain supply, then you're going to increase margins, and so it might slow down, but then you'd see companies jump once it got solved. Hard to say. All right, now Wes, let me get your take on this. So, based on some of the algorithms you've got, we got the market opening right now, and based on some of the algorithms you've seen, if if now that I've walked through the setup on Cisco, what do you see? Anything jump out at you in the way of a pip stacker moment, or anything from the other algos that you've worked on?
Actually, I was just trying to find the market magnet algorithm that I had built, so that I could try to offer some sort of feedback or additional insight into that. Unfortunately, I wasn't able to find market magnet, so
Okay,
now
well, no
I'm
worries. We're at the time limit here, so
yeah.
I'm going to make a quick look at the 5-minute chart and see how we're opening. So the first candle coming in here is looks like it's going down on both the Nasdaq and the Aussie yen, but we'll see if that continues. My guess is that somewhere throughout the day and tomorrow, or I mean, somewhere throughout the day, we will see a little bit of a dip that you can buy, and that should take us into today and tomorrow. I don't expect the selling to be really heavy through the end of the month. And end of the turn of month situation is stocks that have been beaten down, but in a generally bullish market, they tend to be good buys. So I'm a big fan of looking for stuff that's sold down a little too much, and being a buyer, um, at least for the next week or two. Everything is short term right now between now and May. Don't get crazy. Don't get yourself committed into big stuff, because that selling will come. It might not last too long. If it doesn't, great. That means we got a fantastic bull market coming through the summer. I think the chances are better than even, though, that we're going to see a lot of selling in May, and follow on selling throughout the summer. So we'll see what it does, how the Fed responds, and what investors end up doing. But until next time on Charts and Chats with me next week, everybody take care and trade well.